G'day guys, Simon and Ben here at Pumped On Property. In today's episode, man, we get into some of the ideas that we have. In fact, 10 of the big ideas we have about managing and reducing risk as a property investor.
Man, some of these things have been so important on my journey throughout this accumulation phase to build that portfolio, but just to take stuff out of my head as well, like talking to a pro, talking to an amazing mortgage broker, talking to a great accountant, going through a building and pest report with the building and pest inspector, and just like not having to do all of this stuff alone and really having all of that, having that team, having that process to support my decisions and keep me motivated moving forward.
I love it, man. Because in this one we talk about the big stuff, like a good education, a good plan in place, a good team. We get into some more of the nitty gritty stuff, like after you bought the property, doing your due diligence, or while you're buying the property, making sure you've got good insurance, making sure you've got a great accountant, making sure you've got a good property manager and what to do with them, and making sure you maintain the property, because risk isn't just saving money and having insurance, but it's managing the key people in your life after you've bought the property to reduce your expenses and your downside risk over time as well.
Yeah, you've got to remember that investing in any asset class, including property, it's going to come with its risks. And if there's any way that we can reduce those risks, if you're at the beginning of your journey, even if you've got 10 properties, it's just good to reconnect and check in. And as we worked through this podcast as well, even I was just like, oh man, it's good to go through these different things and think about all of the different aspects that impact a journey to financial freedom.
I love that, man. I remember when I was just starting out, I didn't have any of these things in place. And so for those of you listening to this just starting out today, I think it's a really good guide. And for those of you who have been investing for a while, it might just be a bit of a remembrance of a few things, because once you do have these big rocks down, investing becomes exponentially, firstly, more fun.
Yeah.
And, also a little bit safer over a 30-year journey. So we hope you enjoy it. And if you do, please give us a big 5-star review. So bro, you talk to literally thousands of different investors a year.
Yeah.
And I would say 99% of the people that we speak to, regardless if they own 15 properties or they're just buying their first one, don't quite have a clearly articulated plan. Now, we're not talking about a financial plan. We're not talking about accounting or taxation advice. We're just talking about, I'm Ben Everingham, and in 15 years from now, I would like $100,000 a year of passive income.
Yeah.
So part of what you do in your sessions with people is really just listen and talk about where they are today, where they'd like to be longer term, just getting real about what's obviously holding them back, and then understanding their property investment goals. And then instead of providing them with a plan, because that conversation gives them their own idea, you just educate them on the market and the next immediate step.
Yeah, exactly. I think so many people just make spur of the moment decisions and just do, as opposed to planning first. And I'm a sucker for this, right? We were just talking this morning about my motorbike and the bad decision that I've made there because I didn't plan for it. I just went out there and did it, and now I'm suffering from it.
Got the cool looking bike from the cheaper company, and you're like, fuck, that's why there's a Yamaha or a Honda.
Exactly.
It's
seriously.
there's a Toyotas and motorbikes.
But I was just, talking to some friends, and they're like, sometimes you just got to go through that to figure it out. But then I think about, what I know and what I do best, which is, talking to people about this sort of stuff and property investing and planning for the future. And I'm like, you've just got to actually sit back and think about what you want your life to look like, how you want to live your life, how you want to operate, and where you want to be in the future, because then you've got an idea as to what you're doing it for. You've got the why, the thing that's going to pull you through those tough years, those tough times. And when you start to deviate from that plan, you're going to pick it up a lot quicker. Like for you and I, when we do strategy checks with one another, if we're going to buy another property, it's so easy for us to just go yes or no. That doesn't align with our long-term plan.
I love that, man. I think in terms of managing and reducing risk, planning is the most important thing I failed to do, if you know what I mean. Because I've talked to you about this so openly before. I went and bought 5, 6, 7 properties, and just thinking that my plan was, if I buy enough stuff, I'll get financially free, or I'll end up wealthy, or I'll be in a better financial position. But because the plan was like more properties versus passive income choices, time with my family, I ended up with more properties, which was the plan, and less freedom, more stress, more going on in my life. And so I went through that year when I started to really get this stuff, and I went from having bought like 9 properties back to 2 and cleared the slate of all the stuff that I'd made mistakes on, which I don't advise anyone to do, but I had to do personally. It's just my personality type and what I wanted to do at the time looking at my properties. And I rebuilt a property portfolio slowly over the last, 5 years that would enable me with my plan to get financially free by the age of 50, which is my goal.
And I think like one thing that you had in the beginning of your journey, and one thing that most people that I talk with have, is that they dramatically overset expectations. Like when you were 23, 24, you probably thought you needed 10 to 20 properties.
100%.
And people come in, I'm like, where do you see yourself in 15 years from now? And they go, well, I want to have X amount of properties or X amount of equity. And I'm like, that's awesome. If that's your goal, great, go for it, shoot for the stars. But let's actually analyze this and let's break it down and figure out what we can do, because sometimes 10 properties may actually only have to be 4. And it's like 4 properties is a lot easier for me to stomach than 10 properties. So it's just like that gives you more motivation. It gets you excited. You're like, far out. Like I can see the forest through the trees now, because 10 properties is overwhelming. And sometimes when you're overwhelmed, you don't want to do anything, because you're just like, let's just stay in my little comfort zone, because if I do this, then I know I've got like such a long journey. But if you simplify it, you pull it back, you make it a little bit more of an attainable goal, you're going to feel that motivation. You're going to feel that desire to just push for it and go for it.
Yesterday I caught up with one of our new clients, Dan, who's an absolute legend. Grew up with my sister actually, and has been in the real estate game, is now doing electrical work. And I sort of said, like, what do you guys really, really want? Because I knew he knew all the stuff, but he just didn't know how he was going to, based on his risk profile, get from where he was to where he wanted to be. And him and his partner ultimately said that what they want most is to travel, the freedom, and to work part-time and spend time with their children when they have them. And, she's a month away from having a baby. Now, that was so in contradiction to his other goal, which was, I want $5 million worth of property owned outright, which was the goal that he set when he was 20, that is no longer relevant to this new stage of life, which is more important for him to have health, time with friends, time with his kids, and time with his wife. And I went through the same thing. Like when I set my goal as a 20-year-old, I said, I just want to be a millionaire. I want to be wealthy, and I want money. And that goal is very, very different from, I just want a tiny number of properties owned completely outright that provide me with a passive income for life that is relatively recession-proof. There's no such thing as recession-proof investing, but, because I've got 9 or 10 different incomes from a small number of properties through some of the dual income stuff, it's like I can lose one income and I've only lost 10% of my revenue stream, versus only having one property, losing that one tenant for 6 months and being completely, legs taken out from under you. And what we did after that is we looked at the 3 properties, the financial freedom concept of, he already owned one great property in Wollongong, and he was going to add 2 good properties in Brisbane. And in 15 years' time, with the effect of a 4.8% increase in the value of the properties, his properties would be worth 2.5 mil. He showed me a few different ideas that he had for paying off the debt, and I added a few extras, like using the tax benefit, the surplus income, the principal and interest. And all of a sudden, he was looking at through the 3 properties, over 100 grand a year of income, $2.5 million worth of property, and him and his partner could see how they could own them outright in that time. And he was just like, fuck, and he just went silent. And his partner was like, man, that was so easy.
Yeah.
And then what happened is his brain clicked in and went, well, maybe I can do 5 mil. And I'm like, why don't you just start with this? Yeah. Do this, complete this. I'm like, anyone that figures out how to make 100 grand a year passive can make $1 million, all you have to do is scale it and be willing to take on way more risk.
Without a doubt.
That's all it is.
That's all it is, but it always started with the plan. Like, you guys had not even touched realestate.com. You guys had not even looked at any suburbs yet at that point in time. It was like, let's nail this plan so that we can reduce our risk, so that we can understand exactly what needs to happen over the next 12 months, 2 years, 5 years, 10 years, 15, 20, and you slowly but surely evaluate and outline exactly what that plan is going to be, and then you can kind of get into the bit more granular stuff from that plan. But you always need to start with the plan, and I think a lot of people skip that step and they just go straight to the broker, or they go straight to their bank manager, and they're like, cool, I've been saving my ass off, I've finally got a decent deposit together, I've got a good income, I'm ready to go, let's go. It's like, before you hit the accelerator, let's actually slow down to speed up by creating that plan.
I love that, man. And it wasn't even a plan with him. It was more just like, if you buy this property, today it's going to rent for this amount and it's worth this. And in 15 years, based on this amount of average growth, which is so conservative, and this amount of increase in rent, this is what this property is going to be worth. And it's like, okay, if one property is going to equal that, give or take, how many of these do you want to do? And it's his pick, his own adventure. Like, it's just really, and then it's like, cool, here's an idea. Then all you need to do right now is, he's got the savings, so his next step is buying.
Yeah.
If he didn't have the savings, his next step would be saving. And then if he'd bought all the properties that he wanted to own in 15 years' time, his next step would be reducing the hell out of his risk and paying off debt. And it's like, you're in either saving, buying, or paying off debt mode, and they're the only three things you do as a property investor.
They're the only three things that you need to do, hey. But then, like, obviously once you've got your plan, next thing, and one of the things that we feel as though is super important to reduce that risk, is talk to the pros. Go talk to a mortgage broker, or go talk to a bank manager. Now, for us, we prefer to use a mortgage broker because they've got access to a much, much bigger range of options compared to that individual bank that you're going to. But I just like outsourcing that as well. Like, I don't want to go...
I'm lazy, man. I don't want to go speak to a fucking bank manager and sit in line.
Oh, man, no way. Like, and it's just really nice for me. Like, for the 4 properties that I've bought, literally at every single stage, I've just emailed my mortgage broker, said, hey, I feel as though like I'm getting close to being able to buy right now. What sort of options can we work with? And he goes, okay, send me through this information, a few pay slips, some statements, some information on the properties, and that's all I needed to do. That's it.
You know, I like that one relationship can get you access to between 4 and 20 banks. Like,
yeah.
I have done the bank manager thing, and it was helpful, and I did learn a lot from them, but they only had one product to give me, which was their product. And I'm a comparison guy. Like, I realize that 1% on $1 million is $10K a year. So I'm going to take it seriously. If this bank, for the same level of service, with the same level of quality and security, can give me a 1% discount, like, I want to know about it. I want to save 10 grand a year, or across $2 million of debt, 20 grand a year.
Exactly. And one thing that Paul's done for me as well is he's helped me with those comparisons. It's like, here's option A, here's option B, here's what a principal and interest loan is going to look like, here's what an interest only loan is going to look like, here's what a 10% deposit is going to look like, here's what a 15% deposit is going to look like. That. And it's like, you can then figure out what the best course of action is. And it's just really nice to have that comparison and go, okay, cool. Like, right now, during my accumulation phase, I'm going to prioritize personally going for interest only loans. I'm talking about Simon, myself. I'm going to go interest only loans, but it was nice for him to show me the principal and interest so that I know at some point in time, when I go to that consolidation phase, when I go to that debt reduction phase, what that's going to look like, how much my expenses are going to be. And it really helped me understand, like, not where I'm going to be right now, but where I'm going to be in a few years' time when I move to that phase of my journey as well.
Love that, man, because you don't just have to go, what's the next step? It's like, well, if I own this property based on my position, what would I need to do to get to the one after that?
Yeah.
And they can forecast because they've got the modeling, and I love that.
Yeah.
You know, one of the things that I think is a huge risk for particularly like first, second, third time investors is overvaluing your own ability. And also, what's making you successful is yourself when you're starting out. It's like, I'm learning, I'm backing myself, I'm saving, I'm hustling, I'm learning all this shit all the time online, I'm talking to people. And so that like I'm at the center of this change in my life becomes I can do it all on my own and I'm better than other people at doing things. And it's like, it's a huge downside to a first, second, third time investor because, you know, when people used to say you're only as strong as your weakest team member, I'm like, no, like I am the team and these people are just orbiting around me to do what I need them to do. But now it's like my team's at the center and I'm just orbiting around them. And when they hit the ball, I'm hitting it back.
Seriously, that's such a good analogy. I love that so much.
Yeah, like they do 90% of the heavy lifting and I'm just, you said you needed this document, here it is.
Yeah.
You said that I should do this search as a solicitor or a town planner, or I should get this report as a building inspector. Here it is. Like, what do I need to know about this?
Yeah.
Like, let them do what they do and find great people, because the risk of not having the right town planner, solicitor, broker, property manager, accountant is fucking severe. Like, really dangerous.
And like, I look at, you know, we always use these sports analogies because we're sports guys. And it's just like, you look at the best athletes around the world and none of them are doing it alone. They've all got their nutritionist. They've all got their like life coach. They've all got their personal trainers. They've all got their team, their coaches within the team, the organization. Like, their success isn't because of them. Their success is because of all these other people. But then you look at other sports people that do try and do it alone, that have got the big chip on their shoulder and they're like FTW.
Burn out.
They never get to that level, or they burn out. They can't maintain that level for a long time. And it's like, reaching financial freedom, it's not going to happen overnight. Get rich quick, it's not going to happen. Like, plan for the worst, hope for the best. And you know, planning for the worst, look at a 10, 15, 20-year journey. It's like, if you're trying to do it all alone that whole entire time, you're going to burn out, and then it's going to add years onto that journey to financial freedom. Yet if you just have the right people supporting you, motivating you, making your life easier, you're going to be able to pull yourself through.
I love it, man. Like, it's easy to look at like a LeBron James, like best in the world, and go, well, he's investing $1 million a year on nutritionists, massage, sleep therapists, mindset coaches, like chefs and trainers and people that can help him with stretching and maintaining his body, and all sorts of injectables to like keep him in peak performance. And it's like a top person, athlete, business person is surrounded by quality.
Yeah.
And it is just like, I keep saying it to my kids every single weekend. It's like, and every single week, it's like, teamwork makes the dream work.
I love it.
You cannot do things. And what I say is, like, if you've got a habit at the moment in your life that feels good today, that is serving some sort of temporary purpose, have a look at what someone that's been doing it for 15 years looks like. Like, have a look at the guy that's like, I can do it all on my own, and how many properties and how much freedom and how much like freedom in his mind and choices in his life he has, or the health decisions of what that could look like of someone that's like neglected that thing, or someone that's neglected relationships, or, you know, neglected their spirituality or mental health. It's like, you can see examples of this because 99% of people live like this everywhere. And it's like, well, what could it look like if I like make that hard choice today to tweak that behavior so that things look better down the line? And I fucking love it. Like, the world is filled with examples of the pro and con. Yeah. Which side of the coin do you want to live on?
Yeah. And I feel as though like that meaningful connection and having that, I guess, like people, the understanding of needing that big team, it's not really talked about all the time. Like, people are just like, you look at the motivational, you know, Instagram pages and things like that, or Twitter pages, whatever it is that you use, and it's just like, you know, hustle hard, head down, ass up, all of this stuff. And I'm like, yeah, like, whilst that is important, especially at the beginning, it is just as important to make sure that you're surrounding yourself with the right people that are just going to keep you on path, and when you deviate, will just nudge you back to where you need to be.
Yeah, like cut the grass versus like come in with the tractor and try and like shred it, you know what I mean?
Exactly.
So I think like the third thing to reducing risk as an investor that we wanted to talk about is this concept of education. Now, I have spent so much time and energy trying to get myself educated. Courses, programs, seminars, books, podcasts, YouTube videos, speaking to people. And 99% of what I did was foundational building. And then all of those things have helped me connect the dots as to what type of investor that I want to be. But education can be a lot simpler than that. And that's what I want to sort of really get through with this. Now, like you're only as strong as like your team, you're only as good as the level of education that you have, and your decisions can be made based on like your best practice is determined by what you know. Now, the best decision that I could have made 10 years ago buying property was okay. The best decision that I can make now with 10,000, 15,000 hours of experience is exponentially better.
100%.
Because there's a process, there's a team, and there's a way of thinking based on education. So, short tracking education, I love the guys at the Property Couch. Their podcast is freaking awesome.
Yeah, those guys have got a really, really clear way of talking about property. They've got so much experience as well, you know, both of them,
if not, the game, and they're buying enough property each year to keep learning too.
Exactly.
You know, like they're at property, I don't know, 800 now or something like that as well, like same as us. And so it's like they're just at a level where they're doing so much that they're seeing the patterns in things.
Yeah.
Phil Anderson's work is incredible. Fred Harrison's work is incredible. Ray Dalio's work's incredible. Like, and then Commonwealth Bank, like insanely good. Heron Todd White,
John Lindemann, Michael Matusik, these guys have got some pretty good information out there as well. John McGrath to an extent as well.
John McGrath, like insane, like the smartest real estate dude in the country, putting the best deals together in the country. Like freely sharing his information on videos, podcasts, blogs every week. And so it's like, with that education, it's like what I thought my education was when I first started was looking on realestate.com. I thought I knew my stuff about real estate when I could look on realestate.com and see what's for sale and make a decision, where now it's like so much of my preparation is in the plan, the team and the education. So little of my activity, like 1% of what I do when I'm buying real estate has to do with buying. 99% is preparation for buying, saving, figuring out which market, getting myself educated to take advantage of it at the right time.
And I love looking back at the history as well, and I think that's really important to educate yourself. So you can start with the high level fundamentals, you know, what's driven capital growth, what areas perform well, but then really going into the data and looking at some of this stuff. And, you know, Jeremy Shepherd has been great for this sort of stuff as well, right? Because he's analysed longer term markets, and I love the fact that he's got more of a longer term outlook on property, because it is a long-term asset. It's not crypto. You know, like 2021 was a massive outlier year. That's not the norm. So looking at that longer term and looking at that data, and like the video that he did with Ryan from On Property, that one was so sick, where he's talking about like the 10-year, like the previous 10 years and how that's going to impact the next 10 years. And, you know, that just helps you make your decisions as well, because then you can look on Google, suburb plus 10-year performance, and then you click on Smart Property Investor and it's going to give you the information. So it's like knowing that markets that have performed extremely well over the previous 10 years have a lower chance of performing as well over the next 10, and vice versa, makes that a little bit easier to understand. So when we're looking at suburbs, we're looking at that 10-year performance, we're looking at their 12-month performance, and then we're looking at how that market as a whole has performed in the past as well, to go, is this somewhere that's going to look okay over the next 10 years? Because none of us can predict the future. None of us know what's going to happen next. But what Phil Anderson says, and you know, from the information from Jeremy Shepherd, it's like you can remember the future by looking at the past. So it just helps you understand. It's like, you know, when you look at these, one of your friends goes, hey, I've got this hot tip of this mining town. It's like, yeah, well, that mining town may have, you know, doubled in value over a 2-3 year period of time, but then what happened? So it's like looking at the past to try and just feel a little bit more comfortable with the decision that you're making.
There's this epic quote that I heard years ago from one of the most successful investors of all time, and it's like, there's nothing new under the sun. Everything has already been created. It's just showing up in a different form.
Yeah.
Like the gold rush is the crypto rush. Like the property boom in Sydney, New York, LA is just history repeating itself after every single recession for the last 100 years. Like these things happen and we just treat them as like new, but it is the consistent thing, and this is what I love about Warren Buffett. Like 10 years ago, he got asked, where will the world be in 2050? What will be the consistent thing? And he said that, what will the world look like? And he said, people will still be people. And it's like, people still want to speculate. They still want to make short-term money. They still want to buy when other people are buying because they feel confident doing that. They want to sell when everyone else is selling and run away from fear. And until like we consciously evolve, I was talking about this with my mate this morning when we were swimming, like until we consciously evolve that fight, flight response out of our psyche because we haven't had a major global conflict for like 2,000 years and it's just disappearing, we're still just going to fuck it up as investors.
Yep.
Because 90% of the marketplace is emotional.
Driven by emotion.
And so it's like that is a huge advantage. And to minimize your risk, like you don't have to do anything but hold long term to do extremely well in this lifetime.
Yeah.
But if you can hold long term and also understand buying dips based on people freaking out and understanding the history of freakouts only lasts between 18 months and 3 years historically, then freakouts are your absolute best friend, even though they feel so uncomfortable. Like when we were buying for 10% below market last year, I was freaking out.
Yeah, me too.
I was like, is this going to last? I was buying the hype, but then I'm like, hang on, let's look at some history, which we went and did and went, fuck, the last 7 times this happened, it actually worked out within 18 months.
And things went pretty good. Exactly.
Not to say that in 2 years' time, there won't be another 10% dip in the stock market and the property market for a year, but things will come and they'll go. And it's like, what happens in 1 year is irrelevant to me. What happens over 10, 15, 20 years is what matters.
100%. And I think it's important when you are educating yourself to like, look at who you're getting your information from. Are you getting it from somebody that has the experience or somebody that might not have that experience? It's like, do they have the runs on the board? How long have they been doing it for? How successful have they been from that? Where are their biases coming from? And just understanding that, maybe buying in the backyard isn't the best decision just because somebody in your life is telling you that you should be doing that. It's always important to be like like a conscious skeptic. Like,
I love that, bro.
Just be cautiously skeptical of like the information that you're getting and who you're getting it from and where their biases are coming from as well. Because, if I didn't know anything about property investing and I bought a property in Sydney in 2012 and it basically doubled in value over that 10-year period, you'd be stoked. And I'm sure that...
Performance bias is deadly.
Right.
Like, I've killed it because I bought there at that lucky time.
So you should do this.
So I'll always do well. Like Tony Robbins talks about in Money Master the Game. It's like, sometimes actually winning doesn't teach you what you need to win again. And it's like very, very dangerous. How many games of soccer have we played where it's like, this is the last team, like the worst team in the comp, and you just scrape through with a win or you actually lose. And it's like, how many semi-finals and stuff have you lost because of that? It's like, just no expectations around what's going to occur, knowing that in any year it could go up 30% or down 30% gives you like a healthy skepticism and a healthy amount of fear to go, I don't want to go all in, but I don't want to be that guy that does nothing and ends up on the pension either. Like, where do you sit?
Yeah, exactly. The next thing to reduce your risk is definitely on the buying side.
Buy better.
Understand how to negotiate, understand the market value, do your research. And this is where the education comes into the buying as well. You need to understand the area, the asset that you're buying to an absolute granular level. And especially in a hot market like we're operating in right now, how important has it been for us to actually understand exactly where market value lies? Because every other week we're having people coming in and smashing our offers out of the park by $50,000 to $100,000 when we were dead sure that this is, maximum market value for us. And that can really affect your longer term performance as well.
Absolutely, man. Like, we don't want to be the speculator. We want to be the investor. And it's why we've been missing out on, 2 out of every 3 offers at the moment, because I'm not prepared to be a speculator. Like, we want to invest. And if someone's prepared to pay that, cool. But I'm not.
Nah.
Right now, until that's a new norm, you don't want to be the outlier.
Yeah.
That property last week that was like 930, I just went, hang on, where's the comparable sales for this, which we provide for every client? And I can't see anything for over 830.
Nah.
Just because this guy got it doesn't mean that it was the right result for the market. And, you know, we don't set records, we just do averages.
And you've got to be happy to walk away as well. Like, you just got to be happy to go, okay, cool. Like, I've put my best foot forward. This is where I see value. This is, you know, if I get this property at this price, I'm going to be really happy. If I have to pay any more, I'm happy to let somebody else have it, because there's always going to be another amazing property just around the corner. Yeah. You know, I remember my first experience buying my first ever property. I found this one in Redcliffe, and it was east of Oxley. It was this like cute little beach shack, 2-bed, 1 bath on it was like only like a 500 square block or something, but I was hell bent that was the right property. And I'm like, so excited for this one. It's literally like 300-400 meters from the beach. It was such a great deal. I put in my offer. Somebody paid a higher price. I missed out on it, and I was just absolutely gutted.
Because you emotionally invest when it's your first few years.
Fully emotionally invested, and I'm like, Ben, should I just go higher? But I didn't really have the serviceability or the ability to go higher. And you're like, just let it go. Like, another one will come up. Lo and behold, 2 weeks later, the deal of the century came up. Yeah, and I'm just better. Like, thank God. Yeah, bigger block, better street, easier house, like all of the things align. And it's just like, you know, it's just, once again, remembering the future. It's like you look at the suburb, there's 150 properties that sell in this suburb every single year. You know, that's plenty of properties to come up. If you miss out on one this week, a couple of weeks down the line, as we say, property is a long-term asset. Nothing's going to change over a couple of weeks. You can just lose out on one and then know that another great property is going to come up.
You know, I truly believe that in the property market, universe, world, whatever, the world is constantly pulling doors open for you, but most people are banging on the door that's shut, and they're like, I can't get this fucking thing open. It's like, because there's another door in front of you, man. You're not supposed to be still focusing on that, but it's like, I've done it so many times. Like, I put so much energy into that one, but like, experience shows me, not just from my own experience, but from clients, that like, almost every time, like almost 100% of the time, unless the market is truly rising by 5% a quarter, you get a better opportunity within a couple of weeks than the one that you had. And it's 100%. Just like trusting. You know, the other thing relating to buying, like understanding market value, we've done heaps of podcasts and videos on. There's a really good series where we talked about in previous podcasts how to find the right market, the right house, the right street, the right suburb, and really went granular if you want to understand this part of risk better. And we've also done another podcast on negotiating, which is the next thing I wanted to talk about relating to buying. Negotiating is, let's say, for example, you're earning $50 an hour or $1,000 an hour or $20 an hour. It is honestly irrelevant, the hourly rate. If you can negotiate in 1 hour from doing a couple of extra calls and save yourself 20K, there is almost no time in your life that you're going to do better. If you can understand the way that psychology works around real estate, like the agents in Freakonomics, like from the study that they did, are not incentivized to get the right price for the client, because if they get them an extra 10K at 2.5% commission on the whole deal, it's irrelevant to them. It's a couple of $100 for some like a huge amount of extra effort versus like, you know, just getting a secure deal done. And so like I see it all the time. Like we've had offers on properties this year that were 50 grand above the offer that was accepted, because the agent took the cash unconditional offer and just fucked their client completely over. So negotiation is powerful. Have a look at our previous podcast because it's too much to get into. But effectively in a hot market, you have to be a little bit more forward and just put your cards on the table, build a better relationship and let it work. In a quiet market, you have so much leverage and time, and you can really play with it and be harder and get what you want. And it doesn't have to be much harder than that.
Yeah, and I think it's just understanding that negotiations is a skill set. You know, it's something that you can teach yourself, you can learn about. There's been amazing books written about it. The Secrets of Power Negotiation by Roger Dawson is a must read for everybody. It actually goes into the psychology of humans and how you can use that not to your advantage, but like to ensure that everybody gets the best result from whatever it is that you're negotiating. Like, it doesn't need to be a win-lose, it needs to be a win-win for everybody to be able to move forward. So just understanding that if it's not something that you feel as though that you're very good at, 20 grand in 1 hour, it is so worthwhile your time. Like, think about what you're trading right now to earn that money. Reading a couple of books, it's a good ROI.
I just hear this all the time, and it's obviously why I've got a business, because I just love negotiating. Like,
you're a natural born
the conflict of like dealing with an agent to me is a laugh. Like, I'm just playful with it and I have fun with it.
And good agents know that too, and they have fun with it too. Like,
I was just say to them openly, I'm going to be super cheeky on this call. Like, you're not going to like some of my questions, but I'm going to ask them anyway. Ha ha ha. Like, life's too short to not have a good time. Like, I want it 100%. To be fun. Like, and so, you know, like, when people say like, I just don't feel comfortable asking them that question or pushing back, I'm like,
it's their job.
Are you prepared to work for the next month for that money you could save, like, by asking one extra question?
Legit.
So in our business, we've got a 2-step and a 3-step negotiation process that we follow. That is just, it gets results. And then we've got an after purchasing negotiation process when the agent's a lot more vulnerable and the seller's a lot more vulnerable to discounting as well. And we use those things to get better results. But in a hot market, you lose a lot of your leverage, and no matter how good you are, it's sort of, you just have to pay market value, and that's sort of how it is.
For sure. Now, the next thing to reduce risk is probably one of, if not the most important parts, which is due diligence. Surrounding yourself with a really good team that can look into the property at a far deeper level. So this is town planners, building and pest inspectors, solicitors, mortgage brokers once again. So like really diving into it. Now, building and pest inspectors are amazing. You know, they go around to the property, knock around with a little bit of a stick and
what is that stick, eh?
I don't know, put some random ball on the end and whacking around. It's like, it's great, but they come with this like 200-page report about every single thing that you know about the property, that you need to know about the property. Like, go into every single room, every single part of the property, and it like helps you understand what the property, you know, the issues that are going to come up with the property and everything like that. So just having that, and then understanding what you can potentially do. When am I going to need to renovate? How much money am I going to need to spend on the property? You know, am I getting value for my money right now? Like, that due diligence is just so important. And then having your solicitor to do some of those additional little checks as well. Make sure that you are getting what you've asked for and like making sure there's no flooding issues, making sure that everything is stacking up, just so that you don't have to worry about stressing on all of that stuff. You just get this stuff given to you from pros.
I love that, bro. Like, my question for the solicitor is, what searches would you do?
Yeah.
My question for the building and pest inspector after they've done the report, because I always call them, is what are the major red flags with this property? What issues do you see coming on this property? And would you personally buy this property knowing what you know?
Yep.
And most likely when you ask that last question, they'll be like, hell no, I wouldn't buy it. Or absolutely for these reasons, and I've got a bit of comfort. Like, it's the same thing when you're talking to your mortgage broker. It's like, how much can I borrow, and can you turn that into a formal pre-approval? So I reduce my risk on the way in of going into a contract and having to terminate, or even worse, going into a contract, moving forward with it, then figuring out you can't do something and having financial loss as well as time loss.
And one thing that I've been noticing negotiating a few deals recently is like, in this hot market, agents are just like, you've got to pull out the building and pest, you've got to pull out the finance term, it's not going to get the deal done. And it's just like...
I'm pulling out of the deal then, mate.
Yeah,
I'm not putting myself at risk.
And it's just important to recognise as a buyer or as an investor that like, it's okay, once again, to walk away from that if it's not working in your favour. Because if you don't have certain things in place and something out of the ordinary comes up, like, you know, I'm not a builder. Like, I've got no idea about the structural integrity of a property until I've got my building and pest report. So it's just, and same with mortgage brokers as well. It's like, I don't feel comfortable going forward with a deal if I don't have these terms in place, so that I can't get a triple check on these things.
I love that, man. It's just, you know, part of managing risk is just thinking about the worst case scenario. And the worst case scenario is you buy a lemon that you weren't aware of, or you move forward with the property and can't finance it. And, you know, I've heard of people taking, like, the other side taking people's deposits. Like, that sometimes happens. And it's just understanding that your due diligence again is as strong as your weakest team member. Like I've seen a building and pest report come from a company that we don't use the other day that was 4 pages.
Yeah.
Our building and pest report from our company, even though they're completely OCD, is like 60 to 200 pages. I've seen it's like most of it is just dribble liability stuff, but a lot of it's like extra attention to detail, and they'll take me to they'll take me there, they'll take my phone calls, they'll walk me through the report, they'll even go get some prices on stuff as registered builders so that I can figure out what it's going to cost. And like, as someone who's like a lower risk investor and looking to minimize my risk, those things like make me sleep better and make me feel more comfortable on the purchase.
Yeah, for sure. Now, why don't you take us through the next one here, insurance, because you have had a couple of, just one big thing happen, and thank God that you had your insurance in place there.
Man, insurance is way more important to me than most because I had a tenant burn down my granny flat and destroy my house and drive cars through it and shit. So like for me, I'm so over the top with insurance, it's not funny. Like now, I'm not an insurance broker. I certainly can't legally speak about it in any way. Like, we can't talk about any of the stuff that you guys probably want to talk to us about. We can just talk property, but...
Yeah, it's personal experience.
You know, with insurance, I've now got an insurance broker. I've also got a Microsoft to-do list, which is, you know, Ben annual property to do. And every one of my addresses in there with the date the insurance is due, the policy number, how much I paid for it, what my excess was, just so I've got a bit of a record as well. So when I get a bill from the insurance company, which for some reason inflation was 1%, but their bill's up 15% from the year before, because they expect everyone to just pay it.
Which most people do.
Most people do. I just make sure like I'm aware of what I'm doing. Now, insurance is vital. The reason I work with an insurance broker is after going through my tenant burning down the property, I did have adequate insurance, but there were things that I was a price shopper. I'm not going to lie. I'm a price shopper with houses. I'm a price shopper with insurances. And sometimes being an insurance shopper with relating to price, you can have coverage that is not quite adequate. Now, I was lucky enough to have just enough, but had I had an insurance broker who was like, hey man, this one's an extra $100 a year, but if the worst case happens, you're going to be so much more covered, it would have helped, because with that property, I didn't have landlord's adequate insurance cover. And so I got paid out for 5 weeks of no tenant, and it took me 6 months to renovate the damage. So I was fucked, where now I'm more like, okay, like risk versus reward, an extra $50 per year across 7 properties or 5 properties or 2 properties is a bit of money, but it isn't as much as like the downside risk of like, I had someone in COVID leave the keys in the kitchen sink, and didn't someone bail your property as well? Like,
yeah. Well, they just stopped paying their rent.
I mean, I couldn't do anything about it because there was this thing the government put in about like
that was
COVID.
Scary when that came through.
Dicey, but and luckily it was in a suburb where I'd done my education and research, and the vacancy rate was below 2%, so I could immediately fill it even in COVID. But I think about this shit more than I used to. Yeah,
it's just like a rainy day thing. It's like worst case scenario. You definitely want to make sure it's there, and it's like, insurance is one of those things, it's like, you don't need until you need it.
Yeah, you want it when you need it.
Exactly.
One thing we forgot, which was point 3, I think we skipped it, or I skipped it, is just a buffer too. Speaking of like, one of the biggest things that catches investors out is the rainy day.
Yeah.
Now, a rainy day, in terms of just understanding this historically for people, based on Fred Harrison and Phil Anderson's research, over 250 years in America, 350 years in UK, a rainy day comes about every 7 years. Like maybe every 10 years, and a really, really rainy day comes about once every 14 or so. Yeah. So, you know, how you can prepare is, you know, increase your rents. Don't be the nice tenant, just be the market value tenant. You know, improve the condition of your property so you can maximize the rent before a rainy day. Have a good savings buffer in the bank. You know, look at all of your properties every year from an interest perspective and make sure you've got the lowest rates. Have your insurance broker look at your insurance costs each year and reduce them as much as you can. Like, make sure your manager isn't just stacking prices. Like, control your cost base. But most importantly, just don't take on too much risk, too much debt at the wrong time. And, you know, have that big buffer in place to protect yourself. So, you know, I think a good place to be is like 6 months of no rent from no property, but that's a really big buffer to have when you're accumulating. So, you know, I never had that, but it's like as I've moved from accumulation to consolidation phase, again in our 3 properties, the financial freedom concept, like, fuck yeah, I've prioritised it, because I just realised the other day I walked in here, I was going to buy another property.
Yeah.
I went, my spreadsheet looks at interest, insurance, like holding costs, which include maintenance, management rates, water, insurances. It looks at like best case scenario rent, but I'm like, I'm missing principal, and now I'm on principal across all of my properties. I went, if they increase interest rates by 1% and I'm principal on everything and I'm factored that in, like my out-of-pocket cost could be 130 grand a year more right now based on my debt position. I'm like, I could be fucked.
Yeah, exactly.
So I was like, okay, like let's just start really thinking about this a bit more strategically, and you know, I just let that property go because I just think it was too much risk for me.
Yeah, it's like, you know, this certainly not financial advice in any way, shape or form. It is so personal, and it's probably worthwhile, you know, when you're ready to have that discussion with a financial advisor, and you can run through those scenarios because you know how to set up those spreadsheets, and it's a bit easier for you to calculate those costs. It might not be easy for the average person. So talking to a financial advisor, and they can actually talk you through this. Even maybe a mortgage broker would be able to forecast that for you. But, you know, for me, I've been super aggressive in my accumulation phase, and you know, I haven't been holding huge buffers because I've been trying to accumulate properties, but that was because I understood where we were at in the market. I understood where I was investing. I understood where I was at in my stage of life as well. But, you know, now that I'm thinking about getting married, having kids, I know interest rates are going to be coming up. Like, my whole intention over the next 12 months is to start building up some of those buffers, and, you know, at least getting to a point where I could hold those properties even if I had no tenants in them for 6 months, because I'd prefer to have that buffer there. Worst case scenario, use that buffer, exacerbate that buffer in worst case scenario time, but still be able to hold those properties through. Because what you learn from that data from Phil, from Fred, from Ray, is that over the long term, those properties are going to continue to rise. They're going to keep going up in value. The capital value is going to keep going up. The cash flow is going to keep going up. So I think buffers are underestimated in the sense that if you can hold your properties through times where other people may have to sell, your long-term position is going to be far better off.
100%, bro. Like, and a buffer isn't just as a strategic reducing risk play. A buffer is hey, the market's just turned to shit this year unexpectedly, which could happen any year. Sentiment is excited and then fearful. That is it. There's only it's the
market's a
bipolar.
sentiment driven.
Yeah, the market is a crazy beast that should be medicated, but it's not. And it's like, so what does that mean? It's like your buffer could actually turn into like the biggest opportunity that you have in your lifetime to grab something at a real discount.
For sure.
And you know, it's the same, man. Like when I was accumulating, like I had no awareness of this. I remember on my 3rd property, I paid for the stamp duty and closing costs on a credit card. Like, I'm the other buffer that you never do it. The buffer that I had in place though was good education of the market. So like, let's say that you might have put a lot of your money towards buying, which was absolutely the right thing for you to do in your stage, especially with the security of like this business.
Yeah, of course.
And
all of that comes into play. Like
of
that's
course, you weren't
something.
Just going, hey, I'm gonna like go down to 10k in my bank account. Like you're thinking, hey, I can make 10k next month if I do my job. So like it'll be cool.
Exactly.
And it's like the other buffer that, you know, only the really analytical clients of mine think about is like, if you put down a 20% deposit, and in 2 years' time, because you bought at the right time, your property's gone up 20%, your LVR is now sitting at 60%. And that is a huge buffer because, like, again, worst case scenarios, you get into a little bit of trouble. Like, 1, you can sell. 2, you might be able to talk to the banks about, hey, like, this is where I'm at. Can you just pause things for a little while? 3, you might be able to rip some equity out and just cover some stuff. So there's like lots of ways that we think about this, not just like, hey, this guy's got like 50 grand in the bank and he's going to be okay for 6 months when some other dude's not going to be. But I would highly recommend like slowly working towards putting stuff away for a rainy day, just in case.
Makes you sleep better at night, right?
Definitely.
Yeah. Next one, property management. I love my property manager. They're so good.
They are good.
They are really good. Like, it's just, I don't have to think about my properties at all. I know that they're constantly going to try and chase market value. We set them up and it's like, look, this is the intention for this property. And I'm holding 2 knockdowns. And when you're holding 2 knockdowns, like, there's heaps of maintenance requests that comes up because...
What do you do when you get them?
Yesterday I got one and it's like, downstairs window leaks when it's raining, and coming into a La Nina year and looking at what the forecasts are from the weather people, it's like we're going to be copping a hell of a lot of rain in southeast Queensland. I'm just like, Bunnings, $5, silicone bottle, just fill up those. Tell them that they won't be able to open up the window, but at least water won't be able to come in. But it's just like, they get that and they're like, look, we know that you're not going to replace the window. We know that you're not going to do a big job, but hey, can we do a quick little fix on it?
You buy a pack of Band-Aids and just put 50 Band-Aids around the window just for love.
The waterproof ones. It's a good idea, eh? It's probably cheaper than silicone. No, but like I respect like my tenants, and it always depends where in the property is this maintenance request. Is it somewhere that they use all the time, or is it somewhere that's, you know, out of sight, out of mind, that they don't actually access? But it comes up all the time, and my managers know before they even come to me. It's like, okay, well, here's option 1 solution, here's option 2 solution, here's how much options 1 is going to cost, here's how much option 2 is going to cost, what would you like to do? Hey, I don't like either of those options, can we look at another one, or just go straight for this one? And like, that's it. Like, it's just one email back and forth, done, problem, solution, done.
I love that, man. Like your manager can help you reduce your risk in a heap of ways. One's maintaining and managing the property. You know, another one is making sure the property is like safe for tenancy, like making sure there's pool safety certificates, blind compliance, smoke alarm compliance, electrical safety switch compliance, making sure that balustrades and stuff like that's cool. You know, making sure that it's safe is a big part of their role, and you're putting that responsibility on them as well. Like, another thing that they can do to reduce your risk is be proactive with, you know, increasing your rents. They can also be super proactive, like our managers are, going, hey, the tenants said they're going to leave in a month. Let's get the joint on realestate.com or to our database so that we can fill it so that the vacancy period isn't high. Another one, which is sort of like blending into the next point, and that is what you brought up, maintenance. Like, once you've accumulated your properties, if you're a long-term investor like us that's going to hold for the rest of our lives, you really want to keep them in better nick than I did when I started out. My approach was buy. My managers got it. And then I went through this property like 5 years after I bought it. I'm like, this looks like a knockdown now.
Yeah.
And I had to do this $100,000 reno on it versus just maintaining the small things and having my property manager all over my tenant's ass. Yeah,
and you should be getting at least 3 inspections per year from your manager, and they'll send you through photos. They'll send you through what their recommendations are of what needs to be done. My managers also look at expected work to be done as well. So if it's like, hey, I can see that, you know, the gutters are getting a little bit rusted, or you know, the roof is looking like it might need to be resprayed in the next couple of years, or hey, your hot water system is 10 years old now, it might be getting towards the end of its life. It's like, a good manager will prep you for what's to come. And I think that's so good, because like, to replace a hot water system, to respray a roof, to like redo some of those bigger things, it's cashola, you know, thousands of dollars. And if you're hit with that bill all of a sudden because your manager's not looking after the property properly, it's a big slap in the face, and you might have to use some of that money in your buffer to do the work. Whereas if they come to you 6 months, 12 months before, 2 years before the work needs to be done, you can go, okay, I'm going to put an extra $20 per week away to this maintenance item that I know I'm going to need to do in a couple of years.
I love that, man. The last way I think they can proactively manage your risk and help you with risk reduction is if your tenant's not paying on time and that becomes a pattern, or your tenant's not caring for your property the way that we should have them cared for, they should be, using the tenancy legislation to breach that person, to pull them back into line. And if that person doesn't pull into line, they should be taking corrective action to manage your downside. It pisses me off when managers don't proactively manage the maintenance side or the people being behind on rent hard enough, and that person thinks that they can get away with it, and then it deteriorates your cash flow / quality of your property, and then you lose the tenant. And if it's not a knockdown or if it's not a full renovation, then you're just stuck and you're having to fix stuff every single time. Like if it costs you $5,000 because your manager doesn't police the person in the property every time they move out to repaint and redo carpets, that's $5,000 every 5 years that realistically should be a 10-year expense. And I'm really big on this stuff. So I take the approach that I need to manage my team of advisors, and I set the expectations around how regularly I want them to inspect. I go and look at my properties now once a year, and I provide them with a list of to-dos because I'm seeing things as the owner that they're not. If you can't do that, that's cool. Maybe you can outsource it, or maybe you can just be on your manager's ass. Just set the expectations at the start of the year. I do it every January. This is where my rents are at for every one of my properties. This is where I can see the market's at. I want you to do this or aim to it. And if they say I can't, I'm like, cool, I'm paying you for your advice, but this is where we're shooting for. And I'm just keeping them on track like you should with any person. Boundaries are super important for your team of advisors, and just because they're your manager doesn't mean that you're not their boss.
Exactly.
And that's how it is. And I've only learnt that after 11 years of doing it, by the way. This is all new for me. But man, it's helping to maintain the quality of my properties.
For sure.
What I've also put in place to reduce my risk, sorry, I'm on a bit of a tangent, but there's a few things I'm doing it now, is every time a tenant rolls over, which is only about once every 3 years on my places, because I don't really look after them, but my manager does. I'm not a pain in the ass of a landlord. I'm not in their space, so that's probably good. The properties are nice, but each time they roll over, because I know it's once every 3 years, I get a bond clean, professional cleaner to come in. I get the carpets cleaned. I get anything touched up paint-wise it needs to be. I get the entire outside and inside of the house washed down by a professional. Now, it's actually way cheaper than I was expecting to do that. Driveways, windows, the entire outside of the house in Queensland's only $500-600.
Wow.
If you've got a beachside property, that maintains it big time.
Yeah.
And it's those things mean that the next person moves in and I get the gardens done, I get the lawns weed and fed, I get the garden beds remulched.
Yeah.
$2,000 every 3 years radically improves the quality that's handed back over, because the tenant has to pass it back legally close to that position with the wear and tear, and then I'm doing it again, so it's getting a double dose. And they're proud of the places that they're living in, so they're looking after them more.
It's just important to recognize that you get what you pay for, right? If you go and you shop for the cheapest property manager, then you're going to get what you pay for. With that, if you don't look after the properties, if you don't maintain them well, you get what you pay for. If you've got an unattractive looking property that's tired, that hasn't been well maintained, then that's the type of tenant that you're going to attract, and you're going to pay for that. You really need to treat your investment portfolio like a business, like you would if you were running, your passion project, and just understand that if you want to skimp out on a few different things, then it's going to cost you in one way or another, whether it's through the quality of the tenants or the quality of the people looking after the property. So if you want to be attracting the more premium quality tenants, if you want to make sure that people are going to look after it in the way that you would want to look after it yourself, then you've just got to pay for that. You can't just expect the world for nothing as well.
I really like that, man. One thing that I really used to do that was increasing my risk on my properties was I genuinely care for people, and I think anyone that's listening to this channel genuinely gives a shit about other people. That's why you guys are obviously connecting with us. And I would go, well, okay, the property's not really in the condition that I want it to be, but she's a nice lady, she's got a kid, or they're a really nice family, or he's an older guy. Now I'm you're a really nice person and I'm a nice person, but really nice people don't fuck other people's shit up.
Nah.
So if you share the same values as me, like even when I was at uni, I kept my room and my shared spaces in okay condition. Like the rest of my roommates trashed the joint, but like I had respect because that's where we came from. And it's like, don't be afraid is where I'm getting to there, to just let someone go, especially if you've done your stuff up front and you're buying in an area with a 2% or below vacancy rate. You'll find another tenant in 2 weeks. And because legally you can't boot them on the day, that you've got to give them notice or you've got to finish their lease. So just get your manager to start looking a month before. There'll be no rollover and therefore no fear associated with losing a couple of weeks worth of rent. The last one I wanted to talk on is tax, which we can't talk about at all. But all I will say is to minimize your risk and minimizing your risk through improving your financial position. Get a great accountant, get a great depreciation report, figure out what you can do with your property, because the Australian government is really pro-property, as we all know.
They are, yeah.
The average Labor politician apparently has an average of 2 to 2.4 properties. The average Liberal has an average of 3 investments.
No way, there you go.
So this is why, like, both ways, they don't really want to rock the property boat too much, because it's like they have a lot to lose.
Yeah, they've got a massive vested interest there.
So just go talk to the tax guys. It is black and white. And you only want to maintain that position with your tax. Don't go to these dodgy ass accountants that are dodging your stuff up and saving you this extra dollar by like doing something. Find someone that is absolutely black and white, that knows how the Australian government wants you to interact with it, and do that. Like the last thing you want in your future is like having to worry about something you did in your past. So just do the right thing there. Find a partner that does the right thing. And find someone like that ethically aligns with where you're at.
Yeah, and also I think it helps finding somebody that is into the industry themselves. Like you want an accountant that has some investment properties themselves, because they're gonna, look at it with a fine-tooth comb themselves to make sure that their properties are set up the best possible way. So same with any of these things. I think it is always important to have advisors that are on the same journey as you, that are on the same path as you as well, because you can have more meaningful, deeper conversations about this type of stuff, and it becomes a hell of a lot easier. And you just know that like sometimes you just can't fake experience, right? Having an accountant that's been there, done that, having a broker that's been there, done that, really, really helps.
Think about it before you did your 10,000 hours in property versus now. Like, you cannot fake experience. You can read all the books, you can listen to all the stuff, but until you've got like the battle scars and the experience, like there's a huge difference having a vested interest. And that's why I only work with people that are doing it, not talking about doing it.
Exactly. But we just want the best for everybody out there, and we're just trying to always look at different ways to reduce our risk, increase our income, reduce our vacancy, whatever it might be. So I hope you guys have learned a few things from this, and hopefully you can action a couple of things from this podcast today as well to, hopefully reduce a little bit of risk in your portfolio, or if you haven't got started yet, implement these things from the very beginning so that you can avoid having to change things up.
We talked about a lot of things, and I'm going to really quickly summarize them because there was a lot to get through, and some of them will be more important to you than others. But having a plan or working with someone that can help you put some ideas or a plan in place is great. Finding a broker or a bank manager that can help you support you with that, like getting a buffer in place for a rainy day, because we know historically rainy days come through. So just understand that. Get educated on the market and the history so that you can make better decisions, and you're not a buyer at the top every time you buy and you've lost your first 10 years of gains because of the way that you invest that way. When you buy, understand market value and understand there's always another door that will open. But remember that negotiating is probably the best use of your time and the best skill set that you can develop in your career, in your personal life, with your children, and also buying property too. Mm-hmm. Do your due diligence with your town planners, building and pest inspectors, solicitors, accountants, tax depreciation specialists, builders, certifiers, engineers, like whoever you need to feel comfortable about your buy is what you should do. If the building and pest inspector says, something looks dicey here with the electrical, don't go, that looks dicey. Get an electrician or a plumber or a builder or an engineer or a gardener to come out and figure out what that issue really is, and then weigh up the risk with your solicitor and decide what you want to do.
Yep.
Get insurance in place, and always have the right cover, because something will happen over 30 years as an investor with your portfolio, and you want to make sure that you've got something in place to protect your downside. Get a great property manager, maintain your property well, and you're only as strong as your accountant as an investor too. The Australian government is so supportive of property investors, more than any other asset class by far. There are so many things that they do to stimulate the Australian property market. Find out someone who understands that stuff and then safely navigate your way through that with that person. But I've enjoyed this, man. Like, what's cool is, like, I feel like we're actually doing this stuff, not just talking about it.
It's good to reconnect to all of these things as well, and just recognize and just remember how important it is to have all of these different things in play to sleep better at night, get the best result from your portfolio, and just enjoy the journey, as opposed to just being a stressed out person the whole entire time. Because if there's, cracks, or if there's, if these things aren't all sorted, then it's going to impact everything in your life. You're going to feel more stress. It's going to impact your relationships. It's going to impact your work. It's going to impact your decisions. So just get on top of it. Start with the plan from the very beginning. Map all of this out, and then slowly but surely it's all going to come together with a bit of experience.
Now, I don't normally do this on podcasts, but I'm going to do it on this one. For those of you who are seriously thinking about buying a property in the next 12 months, whether the market's positive, negative, or neutral, we would love to offer you a one-on-one strategy session where you can talk with myself, Simon, or one of the team members about exactly where you are, where you want to be, and we can educate you on the market. And you can take that absolutely with a grain of salt and go and smash it on your own. Or alternatively, you could become one of the very small number of clients that we take on each week and each month. And then, through doing that, the reason I'm sort of saying this is we have an incredible accountant, an incredible town planner, an incredible building and pest inspector, an incredible property manager. And so many of our clients have come to us for one property. So many others have come to us for multiple properties to help them build their financial dream out. But in reality, all of them have walked away with an incredible bunch of people that they can lean on, and they know that they've got us, and any time that they need an introduction to someone to help with something specific, these aren't people that we're getting referrals from or anything like that. These are just people that I have found personally that, do the job and that are pretty diligent. Nobody's perfect, but these people are a bit more OCD than the average, which I like. And because of that, you can walk away with not just a great property for the long-term future and a better understanding of the market, but a fucking world-class team of advisors so that you can comfortably continue to manage your own risk long-term with your portfolio through those partners as well.
Hell yeah. I hope I get a chance to chat with some of you.
So to do that, I think just jump over to www.pumpedonproperty.com and book that in. And we'd love to hear from you. We'd love to talk. And, regardless of if we hear from you or not, we just wish you all the best and all the safety moving forward with your plan.
Oh, sweaty. So sweaty.